Imagine taking just $1,000, the price of a phone or a weekend trip, and watching it grow into tens, even hundreds of thousands of dollars, without working harder, without second jobs, without luck. That's the power of compound interest. It's simple, it's quiet, and it's one of the most powerful financial forces in the world. Albert Einstein even called it the eighth wonder of the world. Today, I'll show you how compound interest works, why most people misunderstand it, and how real people have used it to transform small amounts of money into life-changing wealth. What compound interest really is. Most people think compound interest is just earning interest on your savings. But that's only half the story. Compound interest is your money earning money. And then that new money earning even more money. It's growth on top of growth, like rolling a small snowball down a hill until it becomes huge. It doesn't look impressive at first, but then suddenly, it explodes upward. And the only ingredients you need are time, consistency, patience. Real math, how $1,000 grows over time. Let's put the theory aside. Look at the real numbers. If you invest $1,000 at 5% for 50 years, around $11,500, $1,000 at 10% for 50 years, around $117,000, $1,000 at 20% for 50 years, over $91 million, yes. The same $1,000, different interest rates, and completely different financial realities. This is why wealthy people obsess over compound interest. It's not magic, it's math-first real story.
It's okay, but that doesn't tell you anything about tomorrow.
Well, let's talk about tomorrow. Could anyone do the same thing you did starting today?
If they didn't try and do too much the first week, yeah.
Jacob, the 18-year-old who retired at 40, Jacob wasn't rich. He worked at a grocery store at 18. His manager told him, "If you invest early, compound interest will do the heavy lifting for you." Jacob didn't believe him, but he tried anyway. He put $150 a month into an index fund, earning about 10% a year. Here's what happened. At age 30, $41,000 saved. At age 40, $115,000 saved. At age 50, $300,000. At age 60, $800,000. Plus, Jacob didn't chase crypto, didn't gamble on stocks, didn't take crazy risks. He just showed up every month, consistently. And that's the hidden truth.
I look for a business where I think I know what, in a general way, is going to happen. If you buy a bond, you know exactly what's going to happen. If it's assuming it's a good bond, a U.S. government bond. If it says 9% coupons, you know what the 9% coupons are going to be for maybe 30 years if it's a 30-year bond. Now, when you buy a business, you're buying something with coupons on it too, except the only problem is they don't print in the amount. And it's my job to print in the amount on the coupon. And some companies I feel capable of doing that with, and others I don't have the faintest idea.
You seem to stay away from high-tech companies.
You name 10 high-tech companies to me and ask me where they're going to be in 10 years or 10 months, and I don't have the faintest idea. So that would be exactly like buying cocoa beans or something. I just don't know what's going to happen.
You don't need to be a genius to win the money game. You just need to start early. Why time matters more than income. Here's a mind-blowing comparison. Two people invest the exact same amount of money. Emma starts at age 20 and invests $200 per month for 10 years. Michael starts at age 30 and invests $200 per month for 35 years. Who ends with more? Most people guess Michael because he invested 3.5 times longer. But the truth, Emma wins. Even though she stopped investing after 10 years, her money had more time to compound. That's how powerful time is. It beats hard work. Story 2 is the late starter who still won. Not everyone starts early. Meet Lisa. She was 40 when she discovered investing, late by most standards. But instead of saying it's too late, she said, "I'll start now." She invested $300 a month into an index fund earning 8%. At age 40, $0 at age 50, $54,000 at age 60, $175,000 at age 70, $430,000 plus. She didn't become a millionaire, and she didn't need to. She built her own safety net, her dignity, her peace of mind, and she told her daughter something powerful. You can't control when you start, but you can control whether you start.
You have been talking this philosophy for years. It's no secret.
It's no secret.
Why doesn't everybody do it?
Well, it requires patience, which a lot of people don't have. And people would much rather be promised that they're going to win a lottery ticket next week than that they're going to get rich slowly. Gus Levy used to say that he was long-term greedy, not short-term greedy. And if you're short-term greedy, you probably won't get a very good long-term result.
You've said they could close the New York Stock Exchange for 2 years and you wouldn't care. Can you explain that?
We own parts of businesses when we own stocks. And the New York Stock Exchange being open has nothing to do whether the Washington Post is getting more valuable over a 5 or 10 year period. And what we want to do is be right on the business. If we're right on the business, the market will take care of itself. And if the stock exchange closes on Saturday and Sunday, and I don't break out in hives, so if it closes for a couple of years and the business does well, we'll do very well.
The 20% trap. Why big returns aren't the goal. Everyone loves the idea of turning $1,000 into $91 million. That 20% example earlier. But here's the truth. Chasing high returns is how people lose money. Crypto scams, meme stocks, hype projects. They promise big returns fast. But 95% of people lose. Buffett said it best. If you don't understand it, don't invest in it. What can you understand? Things like index funds, ETFs, solid companies with long track records. These won't double your money in a week, but they'll protect and grow it for decades.
In your annual report, you say that if you're in a poker game for 30 minutes and you don't know who the patsy is, you're the patsy.
You've got it.
How do you apply that to the market or to investing?
In the market, if you think the market knows more about what your business, in other words, if your stock goes down 10% and that upsets you, it obviously means that you think the market knows more about the company than you do. And in that case, you're the patsy. If it goes down 10% and you want to buy more because you know the business is worth just as much as when you bought it before, or perhaps a little bit more with the passage of time, so you buy more, they're the patsy.
Next story is the man who chased fast money. Mark wanted to get rich fast. He put his emergency fund, $4,000, into a crypto project a friend hyped up. In 1 month, it grew 200%. He felt unstoppable. In month 2, it crashed 90%. He lost almost everything, not because he was stupid, but because he wanted the result without the patience. He later said, "If I had just put it in an index fund, I'd still have the money today." Lesson: slow, steady growth beats fast, risky hype. Every time, how you can start today. Action plan. You don't need thousands to begin. You need momentum. Here's your plan. Step 1, start with $100. Invest it. Step 2, add $5 a day or $150 a month. Step 3, put it into something simple like an S&P 500 index fund. Step 4, don't touch it. Don't chase hype. Step 5, let time do its work. Everyone wants to be wealthy. Almost no one wants to be patient. But the people who win financially aren't the smartest. They're the most consistent. Compound interest is quiet, patient, and unbelievably powerful. If you respect it, it will transform your future. Start small. Think long-term. Your freedom starts today.